The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. And as we continue here at the NAFB convention in Kansas City, Missouri, joining us now for a conversation. Always good to talk with our friend David Widmar from Agricultural Economic Insights and getting to do so in person. It's good to see you, buddy. How are you?
Good to see you as well. Yes, good to see the faces behind all the voices.
Yeah, all the microphones and everything else. And I'm sure you've had a lot of microphones in front of you today for trade talk and everything else.
Yep.
Yeah, but an important time to talk with the nation's farm broadcasters and talk with folks about some of the headwinds, the challenges, and the good things. There's a lot going on in agriculture right now, of course. And then, we've talked many times. You just look at the markets, been a good rally, but the ag economy struggling. There's a lot churning out there. There's some optimism, but plenty of uncertainty, I think.
That's exactly the way to think about that. I think the time of the year is really important. I think for producers also to keep in mind, we're reviewing what happened in 2025. We're making plans for 2026. And I think that's why this trade show is a really great time to kick off. You talked about uncertainty. It reminds me of that Chinese proverb, or a curse, I should say, to their enemy, may you live in uncertain times. I'm hoping that for 2026, our producers out there can have less uncertainty. They get some confidence around markets and trade and commodity prices and, of course, profitability in their operation.
Well, thinking about this, we wrap up harvest, closing out the year. We're starting to make some decisions for next year. Where do things stand? What are the takeaways? What are we feeling right now in terms of the overall ag economy and even the acreage debate already happening, things like that? I mean, what are you tracking closely here near the end of the year?
Well, I think the first thing that producers need to think about is where are they standing for 2025? I would recommend, as they look at their financial performance, keep in mind that there was a ad hoc payment that they got in the spring from 2024 production. Big uncertainty here that we're going to get some resolution on, hopefully in the next few weeks, is another round of potential trade aid, or not trade aid, MFP, or not MFP either, of ad hoc payments. A lot of acronyms here throwing at you. These ad hoc payments, will we get another round? Maybe it's trade aid, maybe it's economic assistance. Haven't been clear out of DC yet what that might look like, but that could ultimately also impact how profitable 2025 looks like. We had $30 to $40 an acre payments back in the spring. That's huge on the budgets. Thinking about 2026, I think we're going to really be focusing on acreage. Soybeans have a tightening ending stock situation. Corn has a growing ending stock situation. And since the trade news came out, we've seen some improvement in that, or an increase in that soybean corn price ratio, which could impact that acreage allocation.
And I think that's the interesting thing here to look at is, so the early chatter is, well, maybe we won't move away from corn acres. We had such a large amount this year, and maybe we'll stay on corn. You pencil things out and it still looks better for corn. Like I've heard that conversation, or that comment anyway. But it's interesting when you look at those ratios and look at the outlooks and the data and try to calculate things that, maybe there could be a little more balance, so to speak, next year.
Right. I think there's never an absolute number that's true for every farm.
No, there's not.
And I think one of the things is, yes, corn still has a budget appeal, especially if you're in the Great Plains versus the Eastern Corn Belt. But that appeal is less than we saw in 2025. So that's true from the budgets. It's also true from the price ratio. We had a spring crop insurance price ratio of about 2.24. It was the lowest going back to 2012. Not a surprise. We planted so many corn acres. We have seen since, the last 60 days, a lot of movement between 2.3 and 2.4 in that 26 price ratio. So that's an improvement over 2025. I'd also add a little asterisk here. Going from 2.3 to 2.4 is a 2.2 million acre tug of war between corn and soybeans. So this is a pretty consequential change that we've seen. We went kind of 2 round trips between 2.3 and 2.4 in the last few months. What are we watching for? As trade sort of materializes from China, how much are we going to be able to send them in the next few months, and how long do we get to send them soybeans into the spring? And then, of course, that trade, that price ratio, if we see things turn unfavorably, that price ratio could have a lot of volatility to the downside.
And I think it's an ongoing conversation, right? And I'm sure you've talked with folks here at NAFB. I have as well. Everyone's kind of, they're shopping around for their inputs. They're not necessarily making a lot of big decisions quickly, so there could be there could be some ebb and flow and uncertainty here into March timeframe, even like really early spring. It sounds like, just with some unknowns in front of us.
So I think what producers need to be thinking about is, one, how much uncertainty do they really have in their crop rotations? Are they going to plant, 25%, 75%, 80% of the corn acreage last year? Yes, possibly. So they probably need to be making those decisions. And I'll tell you why. I think that the retail supply chain is also facing higher interest costs. Higher interest costs for them means it costs money to have this inventory on hand. And so we don't want to get into a situation where you're hoping to plant all these corn acres and you don't make those commitments, and then you can't get the inputs that you want. I think that's a new risk. We haven't dealt with a higher interest rate environment for quite a while. I think it's starting to also make its way into how much inventory is on the shelves.
Talking with David Widmar from Agricultural Economic Insights. You can find them at aei.ag. What about land values? I know you guys had a new report on this here, kind of looking at maybe some of the headwinds that are out there and just overall land values and where things stand. That's another piece of this overall farm economy. It's extremely important. And where do things stand when it comes to land values here as we're looking at 26?
Well, the headlines have all said farmland values are cooling, but cooling is an ambiguous term. So it could mean, down quite a bit or up a little bit. But what we've seen is that, if you start at 0 year-over-year change, some surveys are showing 1 or 2% increase. Some are saying 1 or 2% decrease. So cooling means we're sort of reverting back to close to neutral. It depends on what survey, what time frames are compared. When we looked at, Indiana data, we dug really deep. We looked back all the way to the 1970s. We had a couple concerns that came up. One of them is that cash rent relative to budgeted revenue is really high in terms of the contribution margins. What does that mean? We have revenue. We take out our variable costs of seed, fertilizer, crop protection, crop insurance, fuel, repairs, and then we have contribution margin. And that contribution margin we use to pay rent, we use to pay our family living, we use to service our debt, cover our machinery expenses, and that contribution margin relative to rent is bigger than contribution margin. So that means we actually have to pay a little bit more to rent than what it's going to generate back for our operation. So that's headwind number one. Headwind number two is farmland still is in a low interest rate environment. It's still priced in a low interest rate environment. So cash rent divided by the land values is around 2.2%. Historically, 10-year treasuries have closely mirrored that relationship, and 10-year treasuries are closer to 4%. So there could be some adjustment that happens there in 2026.
What else? Thinking about just all the adjustments across agriculture, I think we're going to have to see some reshuffling or rebalancing, whether it's land values or input prices or more. And so when you look at it through the lens of an economist, I mean, what are going to be those key areas that we have to keep an eye on here moving into 2026?
Well, that's a great question. I think the one thing that we've had here that's been a lifesaver and that gets overlooked are these government payments. So the government payments that we've been receiving allows producers to have a little bit more time to make some adjustments. So it's kind of like getting this battleship turned a little bit, it takes the pressure on how fast we have to turn these battleships. And so that's been a really huge improvement. The other good development is that the livestock sector has been doing pretty well. So that's keeping lenders comfortable. It's keeping operations that have multiple enterprises in a comfortable situation. But yes, the changes that we have to watch, I think cash rent is at the top of that list. If you're thinking about what levers can producers pull to make adjustments on their operation, capital purchases, we've seen the equipment industry responding to less activity in the capital purchase side of things. I think longer term, you think about the ratios onto the farm level, producers are going to have to really think about their profitability, their working capital, and ultimately their debt obligations. I like to think of it as like a pipe pouring into a barrel, and then there's a spigot coming out the bottom of the barrel. Profits pour into the working capital barrel. Lots of profits fill that barrel up. Then we think about what are the draws on that. So it's debt service, it's family living, it's capital purchases, and we got to be sure we're adjusting those valves. For producers, get your operation back to profitability as quickly as possible.
I know folks want to follow along. You guys have a ton of great stuff at aei.ag. You have the premium site. You have various podcasts out there. I know you do some stuff with our friend Tommy Grisafi at Ag Bull. A lot of things. It's simply go to aei.ag to find all the information, right, David?
Yep, we're focused on trends in the farm economy, and we apply it to decisions that farm managers have got to do. So we're not going to be breaking news, but we're going to break it down so you can make better decisions on your operation, or you can help the operations you work with make better decisions.
aei.ag for more. David Widmar, economist with Agricultural Economic Insights. Always good to see you, sir. Thanks for joining us. Happy Thanksgiving and
Thank you,
holiday
Jesse.
season ahead.
Yep, thank you.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.